Hello, everybody. I'm Professor Randy Nordby. Just wanted to quickly give you a quick introduction to myself if you haven't met me before. And if you have met me, hopefully you've woken up by now. I know sometimes this stuff can get a little bit dry. You're going to find I'm going to bring a little excitement to what you're doing and, more importantly, help you understand why you're doing this. So a few things to think about. With equity portfolio management, I'm an old equity portfolio manager guy. I'm a fundamental, show me the cash flow, non-excitement. When my firm where I previously worked underwrote Facebook, I was the one like, hey, who's going to actually, care that I'm sitting at Starbucks and want to follow what I'm doing during the day? I think I'm not as exciting as the Kardashians. But anyway, so let's talk a little about equity portfolio management. Again, for you guys that congratulations on passing level 2. I need to tell you, if you're an equity guy like me, you're going to be a little disappointed with this section. Basically, what you're going to see, this material is very much about portfolio management. It's not about valuation. It's not about stock picking. It's not this, what I call the sexy side of finance. This is more getting down to the nuts and bolts. What does the client want? And can you build something to fit that client's needs? So that's what I want you to think about this material. And again, I want you guys to even take a step further back. Why do we invest in equities? So after a career for about 14 years in the industry, and now I'm currently a professor at American University in Washington, D.C., I've had some time to really think about it. And I've really come back to a real simple answer. Why do we invest in equities? It's really simple: to make money. We buy equities because they make more money than bonds. I know a few years ago, I could put money in my savings account in my bank, and as long as I'm willing for the money to double every 7,200 years, that's about all you could get. So since the financial crisis, really been a movement into equities, and again, we've had a very nice run in the bull market. We're getting close here to running up to 9 years. So again, think about, why do we invest in equities? We invest in equities to make money, and hopefully to hedge inflation, and also to lower our standard of living risk. Could it be in the constructed response in the morning? Sure. Could it be in an item set? Sure. We don't really know. The way the CFA is, they've pretty much set this material, everything is 100% portfolio management. So you could see everything in the constructed responses. So as you go through this, I'm going to point out some key facts and some key things that you need to know. But just remember, this is a lot of soft terminology. There's a lot of things here to remember. I teach the CFA class in Washington, D.C. in level 3. And what I always tell my students, the reason that you use Kaplan, and the reason that we're here to help you, we're not here to teach you to be an equity portfolio manager solely, or a derivatives expert, or a fixed income expert. We're here to do one thing: help you pass the test and get your life back. My wife, when I was going through the CFA program, she used to call herself a CFA widow. And I used to say, no, you're going to get me in trouble already. You're a CFA candidate widow. I'm not a CFA charter holder yet, so you can't say that. So again, I understand now you're level 3, you're towards the end. So I tell you this, let's get serious, let's buckle up, let's get this done, and let's make sure this is the last year that you ever study equities for the CFA exam. Okay, so I want to move forward a little bit, and let's dive into the material. So again, I told you the main reason, it only took me 14 years to figure this out. We buy stocks for capital appreciation. So basically, you start thinking about, well, what's the main driver of long-term equity returns? Well, guess what? They're going to have some growth in cash flows, some revenue, some earnings. And again, as I mentioned this, and I can't stress this enough, the reason that we do this is to make money, and in fact, make more money than bonds and treasuries, and again, a savings account. Now, this is the other thing that you need to remember. Equities tend to outperform other major asset classes during periods of strong economic growth. But remember vice versa. They also underperform major asset classes during periods of weak economic growth. So at the time of this taping, the stock market has been up almost 9 years in a row. I have a feeling sometime in the near future, don't be surprised if we see some weak economic growth. And as Warren Buffett says, eventually we find out who's swimming naked in the swimming pool. You know, right now, my 5-year-old son could probably have picked very successful stocks. But when it comes down to what stock should you own when things go badly and the economy is tough, maybe we have a trade war or threats of nuclear explosion, who knows? It's been kind of a reality show lately. So again, as we go through this, just always take a 30,000-foot level. Why do we do this? Because ultimately, we believe we can make long-term, significant returns. Now, we're going to challenge a lot of your thoughts in this material today. So here's the thing. I know when I first started in the industry, everything was about dividends. Hey, dividend income. Companies would come out, we haven't missed a dividend in 60 years. We haven't missed a dividend in 100 years. There was this ingrained thought in our heads that well-established companies pay dividends. And that annual dividend yield, you know, it's always hovered around 1 to 3%. And what's even more important, if you're trying to value these companies, hey, a dividend growth model, our old friend Gordon Growth, you know, dividend yields were much more stable and much easier to forecast than equity returns. And in fact, if a company lowered their dividends, that was a signal to everybody that we've got major problems here with this company. Now, the reality is today, a lot of companies don't pay dividends. So I think, unfortunately, this is something that's changed over the last 10 years. You're more likely to see a company do share buyback than pay dividends, but it doesn't mean we can ignore dividends. There are still certain industries where dividends are very heavily and very important part of these firms' capital raising process. So what's another reason? So dividend income, I'm not so sure that's the reason we buy stocks anymore. But diversification benefits, absolutely. Equities tend to actually give us diversification as long as they're not perfectly correlated with other asset classes. This goes back to Harry Markowitz and modern portfolio theory. So at the end, diversification matters, unfortunately, until it doesn't. We saw in the financial crisis of 2007, 2008, you know, there's a lot of academic papers out here. Did diversification work? Did it not? If you remember your portfolio maybe down 20, 30, 40%, you might question whether diversification really worked. One of the issues that we really focus on, and I want to highlight you to this. So bottom line is during a financial crisis, correlations unfortunately tend to increase. So, you know, maybe you thought by owning all of these companies, hey, I've got small cap, I've got mid cap, I've got international. You know, we thought we were getting some type of correlation. We thought we were getting diversification. Unfortunately, and especially in the emerging markets, we came up with this term that academics call contagion. It almost sounds like a virus. It almost sounds something, I've got a lot of medical personnel in my family, and it almost sounds like something that they would be dealing with. Well, that's exactly right. You know, it goes back to the saying, when America gets a cold or sneezes, the rest of the world gets a cold. So that's sort of this thought process. So during financial crisis, does diversification work or not? I don't know, it's kind of out there right now. A lot of academic papers, and we tend to see mixed results, unfortunately. And then the other thing that we see during extreme financial crisis, risk really increases as measured by standard deviation. So again, these great last models that we use, hey, all of a sudden standard deviation starts increasing, risk starts increasing, we start to get nervous, we start to hide our 401k statements. But we do tend to get diversification benefits, and especially over the long run. Now, this is a key that I think is really important. I want you to think about potential inflation hedge. Just because you buy a stock, It does not mean that you automatically get an inflation hedge. Bringing back my old economics hat, we've got to start thinking about elasticities of demand for these firms. Do they have the ability to pass these prices on to their clients? If it's an extremely competitive market, unfortunately, they tend to not. So we know that inflation over the long run, stocks seem to be, a nice positive correlation. But unfortunately, in the short term, or even some countries, this really doesn't always work. So that's why we say the word potential and not an always inflation hedge. So how can we get around this problem? Well, one of the things that some people do is they'll look at commodity producing companies. Hey, maybe an oil producer. Hey, maybe a gold mining firm. These tend to definitely increase when inflation increases. But these are more of your storable commodities. So these are some things that people do to try to hedge inflation as well. Maybe they might even think about real estate, and we'll talk about later in another section. But just so you know, in general, studies show a positive correlation between equity real returns and inflation, but again, this relationship varies over time and more importantly by country. We don't just buy domestic stocks anymore. It's very common to have portfolios and investments pretty much all over the world. So I think this is the most important thing. As you were taught in the asset allocation section and the constructed responses of this course, you got to do the investment policy statement. And remember what happens. That investment policy statements merge with the capital market expectations, and then you come up with this strategic asset allocation. What are you basing this stuff on? You are basing it on the client. So basically what I want you to think about, your job as a portfolio manager, and especially in the equity world, you have to build products and you have to design products and use products in a way to address the client's concerns, their constraints, their objectives. Remember TTLLURR, objectives and constraints. I can't stress that enough. Constructed response is critical to you passing the exam, and it's going to come up all over the place. And again, when you actually go to pick a portfolio, as a portfolio manager, we don't make cars. We don't make phones. We design portfolios. And how much equity should be in that portfolio? It depends on the client. So one thing that you're going to see in the equity material today, and I want to spend a minute talking about this environmental social governance considerations. This is an extremely important thing happening right now in the industry. In fact, from my research, 1 out of 6 new dollars investing in the market are now linked to environmental social considerations. Now, what are environmental social considerations? I want you to think about this is social investing. This is also called responsible investing, possibly called impact investing. Here's the thing that you need to think about. I spent a number of years in this world, and I'm currently doing a lot of research on environmental social governance considerations and the drivers of value. But what I want you to think about, ESG used to just be negative screening. Hey, take out all the oil stocks. Take out all the companies that are somehow hurting society or doing something bad. Well, now everyone has shifted to positive screening. So how about picking the companies maybe that are oil companies or things that would normally be excluded that are doing the right thing, shifting to more energy efficient strategies, going green. That's what environmental social considerations are all about. It's not about eliminating whole industries, it's about picking the best in each industry. The other thing that's been going very popular, thematic investing. Maybe you want to just invest on companies that are poised to address maybe income disparity, or maybe possibly firms that are doing things in regard to certain themes, waste management, clean energy, clean water, extremely important subjects, and you can design portfolios incorporating these themes. And then finally, I think the buzzword is this impact investing. What is it? Not really sure. Right now in academia, we're still trying to solve these things. There aren't a lot of understanding of even what impact investing is. So to give you an example, from my research, almost all of the S&P 500 companies have sustainability departments, and they're publishing sustainability reports. This is extremely different than the 10K and the financial reports. Firms can put anything they want on the sustainability report. As long as they don't link it to the 10K, there's no Sarbanes-Oxley problems. So you can say, hey, we're the greenest company in the world. We offer the greenest product. And unfortunately, we have to decipher what that means. We're still trying to standardize a lot of this, but again, extremely important areas, and this is tested in level 3 material in a lot of places. So make sure you think about constraints. If a client says, I do not want any companies that produce energy or are producing weapons or something like that, you need to be aware of that, and you would be in violation of that client's and the investment policy statement, which is your legal contract between you and the client. So again, you have to be aware of these things, and best advice to you, a lot of money is going into this space. It's something you have to be aware of, and the CFA Institute is very aware of this. In fact, they have a sustainability team and a department that's publishing papers. If you get a chance, once you finish your exam and you pass, take a look at some of these things. Extremely interesting research. Okay, so let's talk about segmentation. So if we're going to understand something, we've got to classify it. We have to somehow rationalize it and categorize it. So let's think about this. So let's talk about size for a second. What is large cap? What is mid cap? What is small cap? Here's the thing. If we get 30 portfolio managers together with me right now, we might come up with different answers. In fact, I'm sure we will. There are mega caps. Is it a mid cap? Is it a small cap? Could it be a micro cap? So style, it's a little bit confusing. So I want you to pay very close attention when you're categorizing this. Who's doing the categorization? And is that something that you believe? Sort of the rule of thumb when I was starting, small cap was a market cap around $1 billion. Mid cap was somewhere 5 to 7 billion, and large cap was anything over 10 billion. Well, today there's plenty of stocks with over 100 billion market cap. So, is large cap appropriate? Maybe we call those mega caps. Again, a lot of things going on. Another area that causes a lot of confusion when we're trying to segment this equity market is style. Is it growth? Is it value? Is it blend? You know what? This is where it can get really confusing. So a growth stock, well, what do I look at growth? I want to see earnings per share growth. I want to focus on, their sales growth. Maybe value, I'm focusing on cash flow measures. And just know that this can get a little bit dicey. Some companies are right, you wouldn't call them growth or value, they're a blend. And then another thing you can think about, well, we can decompose, as we're going to do in later chapters, our returns, we can decompose the equity markets. We can look at PE ratios, price to book, dividend yield, earnings, book value. And all of these things are important, but not every one of these ideas are important in every industry. You have to figure out what industry you're looking at. You need to understand the drivers, and then you can look at metrics to understand the investment style. So again, I know this is only 5% or so of the exam. Don't get tripped up here. You know what? Just know some of the basics and then move on and study more important chapters that are going to help you. So an equity investment style box. This is our old friend Morningstar. Our Morningstar style box. So what's so great about this? Well, here's the thing. When I was analyzing a company, I could say, oh, well, this investment firm, well, they have large cap value and large cap growth. Ooh, they have some small cap. And I'm looking at my client's diversification. Oh, they have some mid cap. But they're missing all of these. Well, this was a great way when we would analyze a client's portfolio to figure out how diversified they are. Well, now, unfortunately, these morning style boxes are losing a little bit of their popularity. And the reason being, there are many funds out there that are unconstrained. You know, we see this a whole lot in fixed income and especially in alternative investments that we're going to cover in a later section. So this Morningstar or style box, it used to be really easy to classify these companies. Hey, you're a mid cap. Hey, you're a mid cap growth. You're a small cap. I need small cap. It was easier to figure this out. Today, much more difficult and much more challenging. And here's the other thing. Just remember, this is a snapshot in time. So this is right at this moment. Now, for those of you who have taken class with me, you know my wife is a freelance news photographer. So when she takes a picture, that's what it is right at that time you did the analysis. That's the same thing with this style box. It doesn't mean the next day my style might be completely different. So again, do your homework on here. And again, some things are just going to be harder to put into a box. So let's talk about why do we even fool with size and style if they're a little bit hazy, not so clear. This, I think, is the most important thing. You need to address the client consideration. If the client is really concerned about risk, well, then maybe you want to focus on companies that have really strong cash flows, or maybe that pay dividends. You know, we can also get greater diversification by trying to fill out more of that style box instead of everyone being invested in large cap value. And then more importantly, we're going to talk a lot about this today, benchmarking. So here's the problem. If you earn 5%, you know, when you get your CFA charter, this happened to me a lot. I would go to family functions. Oh, Randy, you're the finance guy. I got a question. My portfolio made 7% last year. Is that good? I don't know. What's your portfolio in? What was your benchmark? Did your benchmark make 10%? Because then I would say 7% is terrible. When I used to manage separate managed accounts for a lot of large institutions, you know, maybe the benchmark was down 10%, and I was only down 5%. Hey, I outperformed the market by 500 basis points. You need to thank me. In fact, you know, give me a pat on the back. But reality, sometimes you got fired because you lost 5%, even though the benchmark lost 10%. So again, benchmarking, comparing, how did you do? How should you have done? And then more importantly, I want to talk about a term that we're going to introduce a lot in this material. I want you to think about style drift. So I hired you to be a mid-cap manager. Now you're a large-cap manager. Hey, that's not exactly what I hired you for. And, you know, so I had a good friend of mine that was a portfolio manager in one of the firms I worked at. She was one of the best mid-cap growth managers, and her returns were phenomenal. She was a superstar at my firm. Well, just for fun, you know, as a portfolio manager myself, I wanted to see how is she so good? What's she doing? And I realized pretty quickly, and I did what's called a holding-based analysis, and we'll talk about this later today. I looked at her holdings, and here's the funny thing. All of her stocks were large cap. They weren't mid cap. She was a mid cap growth manager. Most of her stocks were so successful at mid cap, they became large cap. So if you were hiring her for mid cap exposure, you weren't getting it. So she fell victim to style drift. It happens a lot in our industry. We saw this a lot in the financial crisis of 2000 with internet stocks. Technology was poking up everywhere, and certain companies were heavily fined for style drift. So part of our discussion today is going to talk about ways that you can look out for style drift, because the last thing you want to do is have your client realize, hey, I hired you for mid-cap exposure, you're giving me large cap. That is not what the client wants. You did not address the client's needs. So again, extremely important. So how else can we slice and dice this equity market. Well, what about geography? Hey, developed markets. It used to be people just invested in the United States if you're a US citizen. Hey, I don't want international holdings. Now it's not uncommon to have holdings in UK, Germany, but we're not stopping there. When I started out in the industry, remember this term, BRIC. Brazil, Russia, India, and China. They were the next emerging markets. Well, China, I think we can say for the most part, in a lot of ways, might be more like a developed market than an emerging market, but they still have some problems, especially when they freeze their stock market and you can't sell any positions and it's illegal to sell. Russia's been a lot in the news lately. Is it an emerging market? Is it possibly even a frontier market? You know, these are things that we're trying to figure out. Brazil never really has taken off. At times it looks like a superstar and other times it doesn't. And then India and China are probably our two most successful emerging markets that seem to have the most potential. So then the last stage, frontier. So what are we talking about? You know, these countries that are not quite emerging, they're not quite developed. They're certainly not developed, they're not quite emerging. So these might give us a little bit of different exposure in the market. So the bottom line is, we feel to build a proper portfolio, it is not okay to be 100% invested in US stock. You need to start going outside your home country and looking at emerging markets and possibly even frontier markets. They may offer some benefits, but remember, then you're dealing with currency exposure, you're dealing with political risk. You have to look at things a little bit differently, and I would argue it's much more difficult to value emerging market and frontier markets than it is developed markets. Okay, economic activity. Hey, maybe when we want to break it down, what products are you producing? Or how about what companies are you producing or are you engaging during your production process? So we can cover both of those. Next thing, focusing on the economic activity. So one of the primary methods that I tended to use, I use GICs when I was looking at selecting industries and just kind of slicing and dicing and how to break these things apart so I can better understand and take the risk I needed. But there's so many more, ICB, TRBC, RGS. You know, they keep challenging the way that we slice and dice these companies. So not everybody's using GICs, even though I would argue GICs is still pretty much the main focus out there. But how do these work? Well, they all share kind of a common goal. They're going to start with some broad sector, some industry. Then they're going to divide by further subsectors. So maybe if you're looking at technology, hey, there's not just technology, there's hardware, there's software support, there's security, there's programming. All of these things start falling into the same technology bucket, but they're a little bit different. So this is the whole key here. If I can better analyze, compare, and construct what is going on in the benchmark that I'm looking at, then I have a better idea to understand how I want to build my portfolio. So again, this all goes back to diversification, and we're going to argue that we can actually build more diverse portfolios if we're including things that are different. Oh no, the technology market was down today. Hey, great, the banking sector was up. Oh no, the banking sector was down today. Okay, great, utilities were up. So again, I want you to think of it, I kind of joke with my students on campus, but one of the things that you'll also find out about me outside of my addiction to coffee is that I'm afraid of heights. So we went on a business trip recently, and a lot of my colleagues in the city, there was this beautiful elevator that went all the way to the top to one of the biggest buildings. And I'm like, wow, this is fantastic. And really I'm going, oh my God, I'm petrified. I cannot believe I'm going up in an elevator. In fact, it was probably built by the lowest bidder. So while everybody's looking out over this beautiful Chicago view, I'm counting the numbers of cables that are holding up this elevator. That's what I consider diversification. It doesn't mean that the elevator's still not going to fall. But if there's 12 cables or 15 different asset classes or 9 different asset classes that all tend to move differently during certain economic environments, then at least I can feel a little bit more comfortable. So again, diversification is not the panacea. It didn't really help us in 2007 or 2008 or some of our other major crises that we've gone through. But honestly, it's the best that we have at this point until something else comes along. So let's talk about equity indexes and benchmarks. So we can get really interesting with these. We can meet client size and style and geographic location. We can also break down economic activity by sector or industry. Hey, what about world index? Or maybe we're interested in gold. We can find a product that's focused solely on gold mining companies. We can find companies that focus on commodities. We can find pretty much indices and markets that have been created to solve any of these, again, to help us better understand the benchmarks and what we're exposed to.